It's necessary I highlight how government spending influences stock market performance, how government spending influences stock market and performance. So in this case, we want to consider, fiscal policies and government spending play a critical role in shaping, stock market trends as they directly impact economic growth, corporate profitability, and investor sentiments. So below are the key aspects of how fiscal policies and government spending influence stock markets influence the stock market generally. Number one is impact of tax policies, impact of tax policies. So in this regards, we want to consider corporate tax rates as well as some personal income taxes. For corporate tax rates, you discover that lower corporate taxes increase after tax profits, boosting stock, the values of stocks in the market. It boosts stock valuation and investor confidence. So conversely, high tax rate can reduce profitability and dampen market performance. So you have personal income taxes. Changes in personal income taxes affect consumer spending and disposable income. Lower taxes can increase consumption, benefiting retail, consumer goods, and related sectors. Number two is government spending. Government spending. So you have items like stimulus spending. For stimulus and spending, fiscal stimulus packages such as infrastructure investments or direct payments to citizens and can boost economic activity, benefiting cyclical sectors like construction, industrials, and consumer discretionary. There's targeted spending. Specific allocations like renewable energy funding or defense budgets creates opportunities for growth in relevant industries. There's a multiplier effect. The multiplier effect is something that's worth considering. So in this context, increased government spending can stimulate private sector investments, amplifying economic and market growth. Whenever there's increased spending, invariably discover that it will improve corporate profitability, and as companies become more profitable, that would encourage investors to come in, and as they come in, there will be a boost, significant boost in stock prices. Number three is budget deficits and national debts, budget deficit and national debts. So we want to talk about deficit spending. While deficit spending may stimulate short-term economies or economic growth, as the case may be, excessive borrowing can raise concerns about long-term, financial stability, potentially leading to higher interest rate and inflation. Then there's debt levels. So rising national debt may trigger investor caution, affecting bonds and equity markets, especially if fear of reduced government capacity to support the economy emerges. Please like this video and don't forget to subscribe to this channel if you've not done that. Number four is infrastructure investment. When government invest in building infrastructure. So large-scale government investment in infrastructure, example roads, bridges, and even digital networks create jobs and drives demand for material and construction sectors. And these initiatives often have a ripple effect across not just the industry concerned, but it tends to affect other industries. Also, number five is sectoral impacts. Sectoral impact. So we have healthcare. For the healthcare sector, increased spending on public health can benefit pharmaceutical and healthcare companies. And not only that, it may also involve technology and innovation. So policies promoting research and innovation may drive, tech sector growth. Companies in the tech sectors, in the tech sector could benefit from, government expenditure. As for the energy sector, subsidies for renewable energy or fossil fuel investments, affects energy market differently. Number six is inflation and rates and interest rate. Inflation and interest rates. So expansionary fiscal policies can lead to inflationary pressures. If inflation rises too quickly, central banks may decrease or increase, their interest rates, negatively impacting equity market, particularly, high growth sectors like technology. Whenever there's an increase in interest rate, that will increase borrowing costs, and people may no longer borrow as expected, so they have less disposable, income to spend because of the fact that borrowing is kind of restricted because of higher interest rates. Not only that, number seven is investment sentiment, or rather investor sentiments. Investor sentiment. There's positive sentiments. So proactive fiscal measures during economic downturns, example, stimulus checks during a recession, often lead to bullish markets. And there's also negative sentiments. So perceived mismanagement of fiscal policies, such as an excessive or untargeted spending, can lead to bearish market reactions. Number eight is an economic growth correlation. Economic growth correlation. So in this context, we want to talk about GDP growth. So fiscal policies that successfully stimulate economic growth often correlate with stronger stock market performance as corporate earnings and business investment improves. Whenever there's that increase in GDP, it will affect businesses positively, and that will equally boost stock prices. There is the key takeaway here, actually, in summary, is that fiscal policies and government spending are powerful tools influencing stock market trends. So, however, their effectiveness depends on timing, depends on scale, as well as appropriate targeting. While expansionary policies can boost markets in the short term, poorly managed fiscal measures may create imbalance, leading to long-term challenges, for both the economy and the financial markets. So investors should monitor fiscal policy developments to anticipate sectoral and macroeconomic impacts on their portfolio. As an investor, you are equally an economist. By default, you try to study economic policies and see how they affect your portfolio, and take proactive actions wherever necessary. You don't just react. It's important you take proactive actions so that your portfolio will not be affected negatively by by government intervention.